going to be continuing with many of the themes that you've already heard this afternoon in that first session. We heard already about the Baku to Belém mobilization target, the external target of 1.3 trillion US dollars per year to be mobilized. So I guess the question really is now, how do you do that? How do we really operationalize that? That's what we've been hearing just now. How do we turn that into real action? And we're just going to really try and unpack the way forward for investors today. We've got a really esteemed panel here today to help me do that. We have Manfred Schepers here from ILX Fund, Chief Executive Officer. I'm going to go in order that you can see us. We've got Joe Holden, who's Global Head of Investment Research at Mercer. We've got Alessandra Nibbio, who's Head of Blended Finance at BlueOrchard. We have Anand Rajagopal, who's Head of Sustainability Research at Phoenix Asset Management. And we have Jessie Baver, who is Head of Innovative Finance for Mobilisation at BII. So let's get started. So to kick us off, I really wanted to better understand the needs and roles of different stakeholders in the ecosystem. We heard about this value chain, and so thinking about that, how could you each describe how your organizations look at climate finance or broader sustainable investing in developing economies, and where do you see the opportunities? And we're thinking specifically about institutional investors here because we're really thinking about the scale. And so to set the scene, let's start with BII. Jessie, how does BII look at sustainable investing in developing economies? And how might that differ from private investors in the way that they look at the world? And how can we work together, collaborate more to increase those capital flows?
Sure. Thanks, Hazel, and thanks everyone for joining us today. So most of you probably know this, but BII is the UK's development finance institution. So we're entirely government funded, and we have a mandate to support sustainable and inclusive economic growth across Africa and emerging Asia. So we're a little bit different than some pools of private capital because our mandate is really inclusive. We have to support the full range of things that lead to sustainable economic growth in our markets. And that means supporting some transactions that are very high risk, very challenging in very challenging contexts and in new business models or new technologies, more frontier types of risks. And we know that those types of investments are not necessarily going to be suitable for private investors right away or even for a very long time. But then on the other hand, we also work in more mature markets like India, South Africa, Vietnam, where it actually is possible to mobilize private capital right now into our transactions. And so we've worked very hard over the last couple of years to differentiate between these frontier strategies and these mobilizing strategies. In frontier strategies, our role is really to develop markets for the long term, to be the first mover, to prove that concepts work, or to prove that countries are investable, and then over time, hopefully to facilitate the flow of private capital coming into those markets. But then in more mature markets, in more mature sectors like renewable energy or telecoms or some of the middle income countries that we work in, we can actually get private capital in now. And that's where our mobilization strategy comes in. So I guess to keep it simple, there's really three pathways that we can follow to get mobilization impact. The first is crowding commercial capital into our deals right now as we originate them. The second is really recycling capital faster and being more strategic about how and when we exit assets on our balance sheet. So not holding any positions longer than we need to, but actually getting them into the hands of private investors when they're proven out. And the third is working with asset managers to back blended finance funds that they're setting up. So actually using the reach, the distribution capability, and the origination capability of external asset managers to actually increase our efforts. And we can support those managers in a variety of ways. I think the panel today is very interesting because we've got representatives potentially for where all those strategies are relevant. I think an example of the first strategy is what ILX is doing. And we have an MOU with ILX where we can show them assets that we originate. ILX has done a very good job of finding the types of investors that are ready to take risk in our markets right now and don't need concessional capital to do that. And so hopefully Manfred can talk more about that. An example of the last strategy is our work that we're doing with BlueOrchard right now, which we've been very happy to be working with BlueOrchard for many years, actually, on a few blended finance funds. But I think in particular, the recent one that we announced at COP is a great chance where we can use a little bit of our concessional capital to unlock a variety and a large range of commercial capital to come into that fund and invest in climate finance focused bank and microfinance lending in our markets. In that case, blended finance was the right tool for the structure due to the nature of the underlying assets and the needs of the investors, but I'm sure Alessandra can talk more about that. And then meanwhile, for that second strategy, recycling capital faster, I think there's pools of capital out there. Maybe it's insurance money that Anand works on. Maybe it's pension funds and domestic pension funds in our markets where they want seasoned assets. They don't want to take greenfield risk, but after we've proven that a project is working and that a company is viable, we can transition those assets to the private markets faster. So I think all of those strategies play a role, and I'm curious to hear from the panelists, which ones are most relevant and also what we're perhaps missing in that summary. Thank you.
Perfect. Thank you, Jesse. So I'm going to hand over to Anand from a Phoenix Group perspective, but also more generally thinking from an asset owner's perspective. I know that you're very active on the UK's EMDE Investors Task Force. What are you seeing about the different types of institutional investor capital? I'm thinking really insurance capital versus pensions and different types of pensions, etc., and also UK, European. There's lots of different needs out there. How do they vary? Do they vary a lot between them? And what are the largest pools that can really make a difference here?
Thanks for the question, Hazel. It is a very loaded topic. There were at least 15 questions bundled in what you just said. So I'll try to remember each of those parts. And Jesse is absolutely right. I think, you cannot have a one size fits all approach here. The needs of capital sources are very, very different even within the UK itself. Raj, good to see you. You've seen it, from up close and center, I would say. But broadly speaking, you have defined benefit or DB capital versus DC capital, which is defined contribution. Hazel, I'll explain, in terms of broad strokes, what are we talking about? So defined benefit capital is similar to what you see in insurance balance sheets, where the benefit indeed is defined. So what you're purchasing is a right to actually get that benefit, which is on a pre-agreed, more or less pre-agreed defined schedule, right? Which means that you need assets with cash flows that can match your liabilities very well. Until Solvency UK reform passed, which was literally just about a year and a half ago, still awaiting full implementation, it was about asset cash flow fixity, which means you needed cash flows fixed, right? Which means that a vast majority of assets that have a high degree of construction risk in them, just to your point on greenfield versus brownfield, a lot of those assets would simply not be, feasible unless you have an off-taker or a PPA available, which can take that risk out. So in the case of DB or insurance balance sheets, more broadly speaking, you're talking about strictly regulated asset base that you can invest in, which means you are more and more skewed towards investment grade, matching adjustment eligible asset is called in the UK. In the US, which is where I was before I came UK side, you have the NAIC regulated insurers, stringent as well, but not as stringent as the UK regime. I think I would say UK regime, if you can, tailor a product that can meet the needs of UK MA investor base, I think you can pretty much meet the needs of literally any investor base, I would say, just to go on one foot and declare that. I could be wrong. I'll be humble enough to say that. But I think you would have satisfied quite a few needs. Defined contribution, though, is where you and your employer would make certain contributions on a defined pathway. But the outcome itself is not necessarily guaranteed, which means that your asset base that you can invest in is a lot more flexible. So what you see in the DC base is that you can go not just at debt. You could actually invest in equity. You could actually invest in convert instruments. You can invest in sub-investment grade without much of a problem at all, which is why I think even at the BII event at Wilton Park very recently, I think you had Manfred and Alessandra there as well. And you heard us talk about the need to unlock DC capital handily, particularly from the UK perspective. So I just want to, set the scene in terms of your point on DB versus DC and how different types of capital are thinking about it. And it's not that other DC capital outside the UK has not been mobilized. ILX is a classic example. I mean, they have mobilized Dutch pension capital and pension capital from elsewhere very, very nicely. And I don't want to steal any of Manfred's thunder, so we'll come to it. So I think that there is an opportunity, and on the back of Manchon's Accord, which I'm sure we'll go into, in more detail very soon, there is an opportunity to head in that direction. It is much more flexible capital, but you need to satisfy one very key condition, which is a critical sample of customer base in that DC book that you want to turn the page on and invest handily in EM, need to buy into that strategy, which means that storytelling on risk-adjusted returns, that diversification argument, and the really good performance that comes through in all things like GEMS needs to really come out. So that's at least 3 or 4 questions that you asked me of the 10-part point. Now, in terms of where we go, I'm just trying to go back to the question itself. Different product offerings. Okay, if you look at most insurance balance sheets in the UK, they're fairly sophisticated. Why? Because it's a fiercely competitive business. Whether it is Phoenix or LNG or Aviva or others, we are in it with a very strong fight to get more liabilities, which means one thing and one thing simply put: we need to lock the best assets with the best risk-adjusted returns so that we can be the other guy. As simple as that, right? In what we call as the BPA market, or the buyout and buy-in market, which is going through a lot of changes as we speak. You have a lot of the US and the Canadian alternative asset managers, right from the Blackstones to the Apollos to the Brookfields, all coming into this UK BPA market as well. Why? Because corporate pension schemes have a need to de-risk, and once they're fully funded, and those liabilities can then shift over to insurers, who can then basically try to optimize the whole point of investing in assets that yield you much better than the liabilities where you have a certain fixed profile that you need to deliver on, right? So it's an arbitrage business, it's a margin business. You're trying to beat the other guy somehow, which means you're going to look at asset strategy, asset origination in as competitive and as relative value, which means you're agnostic as possible. And that's the way you think about it, which means whether you look at an LNG, Aviva, Phoenix, and others, for the balance sheet, we have invested in IG-rated EM assets, which means that, okay, you may invest in an IG EM bond, fine. There is the Emirati hard currency bond, or the Chilean one and others. But more importantly, on the private market side, you have seen insurers invest directly. Most of these have their in-house asset management teams as well, including us. Directly invest in bonds guaranteed by the World Bank or DFC or MEGA and others. There's also the odd lot private placements that have happened. In addition, when you look at DC capital, of course, you work with specialist asset managers. You have some of them represented on the panel itself. And you go through discretionary asset management mandates where they invest more flexibly because it's allowed to. DC capital can invest flexibly from debt to IG to sub-IG to equity and so on and so forth. So there's a lot to unwrap in there, but I hope I did justice to some of your questions, at least, if not all.
Perfect. No, thank you so much, Anand. And you can see from this explanation, that we have to bridge between a lot of different things when we're thinking about this world and thinking about this scale up. Because I think it's very easy to say that we need to tap into these trillions that are floating about in pensions and insurance, but there's a lot of boxes that need to be ticked to be able to unlock that capital, and they're all different. So I want to hand over to Joe, because Mercer has got quite a front row seat in many of these conversations with different types of investors. What are you seeing in the different types of investors and the different needs that they're each clamoring for in different ways?
So you mentioned a couple of different types of institutional investors. I would go even broader. We've got pension funds, we've got endowments and foundations, we have wealth managers, we have family officers, we have insurers. And you can imagine that sort of the range of objectives from a risk return perspective, but also like non-financial objectives, are huge. Now, much as we'd like to think otherwise, it's our job to help our clients make the very best decisions that they can, as opposed to tell our clients what to do. In the sense that, of course, we've got our own beliefs at Mercer, but it's not our money that we're investing. Our clients are investing their own money. But of course, it is inherent on us to make sure that we've researched the right opportunities and that we're there ready to go when they're ready to go. But I say that's not sort of a one-size-fits-all with all of our investors. Now, if I look at sort of the work that BII are doing here, and just think more broadly about that, how that fits into those different types of investors that we serve. There is no doubt that, for example, there is still a huge kind of clamour amongst institutional investors for private debt. So that's good. We've also just done our large asset owner barometer, as we call it, so a survey of globally large asset owners. And it is very clear that the appetite for investing sustainably and also more specifically in impact opportunities continues to increase. Not universally, not across the board. I maybe don't need to go into some of those regional differences. I'm quite sure you can all sort of understand. But broadly, if you look at the two different facets of what the particular project that we've worked on with you is trying to do, private debt, impact, sustainability, climate, there is still demand for that. So it's positive. Now, all of you sitting in the room, I am assuming, are very immersed in this particular world and are very enthusiastic about the things that can be done. But there is no doubt to my mind that we have to think hard about, almost like, to be blunt about it, the sales job that we need to do to capture the attention of those investors that would unlock these opportunities for you. And I think the previous panel was great. I was sort of sat, ticks, yeah, and all of that was sort of important about, yeah, even down to sort of the language that we use, 100%. But for me, and I for many years worked in public sector with the LGPS at Mercer before I'd sort of moved into research. And quite often we would have lots of people sort of coming to us sort of talking about all the fun things we could do with their money or all of the impact related things that we could do with their money. But there was very, very rarely a solution or, even just any thought given to how you might structure an opportunity or an investment to make it, to your very sort of well-articulated point, something that fit with the goals, the aims, the objectives, the risk-return profile, whatever that an investor was trying to sort of achieve. And I think what your project has done is make it easy for investors. I mean, in the sense that there is so much, we had this conversation earlier, Manfred, there are so many opportunities for institutional investors to look at. And you have to find a way of making it as easy as possible. And there are lots of different ways you've done that in terms of the way that you sort of structured the financing, but also what you've done is essentially been a funnel to take all of the potential opportunities that are out there and funneled them down and made them into something that's workable. Now, there's still a lot of work to do, don't get me wrong, in terms of building momentum around these sorts of ideas. But when I talk about the sales effort, I think some of the things we've talked about are that you could go in, you could find a group of large asset owners that are very in tune with these sorts of opportunities, and you would be preaching to the converted and they'd find some capital and it would be fine. But actually, we could go broader than that. And I think, for the goals that collectively you want to achieve, you're going to have to go broader. But you have to get a bit smarter about how to articulate that and pull people in. So, for example, you might go to a particular investor who, isn't particularly bothered about sustainability, doesn't really have any kind of climate aims. But if you grabbed them on the grounds that they've got a large private debt portfolio that needs some diversification, and then, you sort of go through the list of the different roles that an investment could play, and by the way, you're also sort of achieving climate-related impact goals, brilliant, but that's not the way that you've kind of grabbed them in. And I just sort of have it in my head that if you broaden out that conversation, don't always go with the sort of obvious first, then actually you'll probably get a lot more institutional investors interested in the opportunity. And of course we've got a role to play in that. But I think sort of certainly the things I took away from the last panel were things around the language that we use, collaboration, and really thinking about how to structure and appease to sort of bring the right people to the table.
Perfect, thank you. And I'd like to hand over to Manfred to talk about this, because I know that you've worked for quite some time bridging between development finance, working with DFIs like BII, and bringing in institutional investors. What have you seen as working on the ground, and where are the challenges that you're seeing?
Thank you, Hazel, and thank you for asking me to contribute. Like these conversations are critically important, as the main objectives in relation to coming out of the COP, but also out of Seville, where you had the finance for development. So both 10-year anniversaries after the SDG launch and the Paris Accord, and of course in many areas progress has been made, but in many areas progress is woefully short, and the financial system itself hasn't really adjusted to these challenges. And so in creating ILX, and we were supported by the UK government, the Dutch government, the German government, to try and, on our conviction, create a bridge investment platform for effectively pension funds to co-invest with the development banks, on the premise that their balance sheets in terms of the duration, the risk, the impact, the scale, the governance were perfectly matched. But in history, they'd never really spoken to each other because, of course, public finance entities were created specifically because the private investors weren't willing to do what they did. And so we created the World Bank and BIIs and predecessors of all this to effectively capture via the capital market or government grant the needs that these developing economies had. We live in a different world now, particularly since the SDG launch that more put holistically a framework around the various social and environmental goals, but also, of course, the climate accord. So we, with that funding, went live in 2022. We now manage $1.7 billion on behalf of 3 Dutch pension funds and 2 Danish pension funds. So we're still very young. But what we do is effectively co-finance with the main multilateral development banks. And it's all within the private sector. Of course, sovereign lending is a policy-based lending, so we co-finance with them in their private sector operations. And that captures the multilateral development banks, but also the World Bank Group, the EBRD, African, Asian, Inter-American Development Bank, but also the national development banks of the Netherlands, Germany, France, and also the UK. We're in the process of agreeing our first 2 projects with BII, hopefully before Christmas. But these are milestones because it'll be the first time that these institutions, the same apply to the French Development Bank this year, this is the first time that they are directly co-investing with pension systems. And pension systems are very unique globally in that they are unbelievably large. At the foundation, I come from finance in my entire career, at the foundation of finance are these pension systems. If you take the sovereign wealth systems and the pension systems globally, it's close to $100 trillion. They underpin the financial system. If they turn around, whoever gets their financing is in deep trouble. And the development banking system, which is seen as critical for the transition across the developing economies, from a total stock of balance sheet, it is 1 trillion. So it's about 1/100th of the total pension system. Flow numbers are more or less 1/10, between 5 to 1/10 of that. So this trillions number, which was thrown out when the SDGs were launched in 2015, sounded ridiculously big, but it's actually not so big. It just means that a new system needs to be created. And that the classic systems, via the London Stock Exchange or NASDAQ or the Amsterdam Stock Exchange, are not providing the transition finance that is needed across the emerging markets. Today we're very proud in the Netherlands that the Unilever ice cream spin-off is listed on the Amsterdam Stock Exchange. Some might be sold in emerging markets, but basically it doesn't really change the needle. So our conviction is that development finance itself can stand on its own 2 legs and be an investable asset class. It is the owners of the development banks wanted to scale up. Just look at the UK government in relation to the BII and the mobilisation conversations, but it applies to all the multilateral development banks. It's identified in the COP in terms of the role of private sector finance across the multilateral banking system is integral in the climate objectives through the NGQGs over the coming decade or 2 decades. If it doesn't happen, it's game over. So the MDBs need to scale up in emerging markets, and I think the private sector can play a huge role. There are a couple of things that are critical to doing that. One is data. We've worked very hard on seeing if we can get data aggregated and used so that this strategy of co-investing with development finance is comparable with how the pension funds are today investing in things like high yield bonds, emerging market bonds globally. The scale at which they're investing in those asset classes is in the trillions. We approximate high yield bonds, leverage finance, and emerging market bonds to be an asset class that is close to $9 trillion. So making small shifts in the way conventional finance invests and co-invests with development finance is actually not such a high bar. The data is critical. We exist now for 4 years. We've outperformed those markets by more than 2 percentage points per annum over the 4 years we existed. Since this asset class, we've unlocked the data of development finance since 2005, and over the past 20 years, it has outperformed those asset classes. So there's a real duty on all of us, the people who are working in the financial system, who are researching it or writing about it, the analysts, to talk about this and make the shift. And changing financial behavior is very difficult. So I think the panelists very much reflected, and there are various tricks of the trade, whether or not it's blended finance in relation to some investors that cannot take this risk of the development finance asset class per se. Those who are advising the pension funds, talk to them and enable that. The governments play a big role to making sure that this conversation takes place and that they allow the regulators to look at this asset class as being investable. So I think, big change has been made. The fact that we're meeting here today and we're again discussing it, I think is a clear demonstration. But I'll stop there.
Thank you, Manfred. And I want to move on to Alessandra from BlueOrchard, also an asset manager that specialises in emerging and developing markets. I know that you've got quite a nuanced approach to product design in order to meet different needs and levels of market readiness. And I think this is a theme that is coming out that we should come back to. Could you tell us a little bit more about what you're seeing and learning from your viewpoint in the market?
Yeah, sure. Thank you, Hazel, for inviting me to the panel. And there are, of course, pros and cons of being last in this type of conversation. So I'll try to build on what others have said already, not to be repetitive. But maybe a few words about BlueOrchard. I mean, I see many faces I know in this room, but just for those that don't know, BlueOrchard business, which is somehow complementary to what the colleagues at ILX do. So we are an impact asset manager, which has 25 years of track record and experience in frontier and emerging markets. So on our side, we are those originating the transactions as well, right? So we put together the private and the public capital, but we also do the deal origination. So I would say that's probably the main difference compared to the ILX model that Manfred described. And I would say that maybe to start building up on what Jesse said before in terms of where we do see the role of DFIs in our business model, right? So of course, there are these two, let's say, extremes, if you like. So on one side, there is the mobilizing at scale that we said before. It's very doable these days on the private credit side in the context probably of climate mitigation, if we keep speaking about climate action. But then, of course, we shouldn't forget about climate adaptation as well, right? And it's not just a matter of opening the markets, right? Because I don't think that necessarily investors are kind of shying away from markets. It's also that they are shying away from certain topics, right? So when it comes to adaptation, there are not many strategies out there that could address that impact theme. And so I think that what we have been doing in the context of blending and working with DFI, such as BII, has been to try to pursue these two roads, right, which kind of run in parallel. So on one side is the mobilizing at scale, and on the other side is more like the proof of concept, right? So the pioneering impact, as the BII and BCG colleague described in their paper, which was published some time ago. And I think that's what is important, right? Not to forget one over the other. So it's true that when it comes to private capital, probably for some time we will see more private capital on the private credit side, on the mitigation side, right? There is the scalability, the replicability, but on the adaptation, on the private equity, so when it comes to more complex asset classes and impact themes, you also need to start from somewhere, right? You need to not forget that part. And so we do have at present two strategies in particular that we have been working with the BII colleagues. So one that is already up and running, it's the second vintage is private equity. It's the Insu Resilience Investment Fund. So what we do there is that we invest only in emerging markets in private equity. So we invest in insurance companies and alongside the insurance value chain. So it can be reinsurers, tech companies, data providers. And again, there we did manage to bring in private capital, right? But of course, I mean, I guess the portion of private capital that is in there compared to the ambitions of what a DFI would like to see as capital that is mobilized thanks to their catalytic role is still smaller. But still, you know, we started with an 80 million fund, and now we have a second vintage that is 100 million. And the ambition is really to have, like, you know, other vintages that would grow in size and in scope, right? And this will help us to complement on the data point that Manfred brought up, which is, of course, super important. This is building the track record, right? This is kind of collecting the data. Of course, I mean, if I look at our business, right, we started from financial inclusion. We started from microfinance 25 years ago. And if you look at microfinance there, for example, the contribution of DFIs in terms of de-risking or providing the so-called junior capital, concessional capital is less needed unless you go to certain markets, as we said before, right? There we were able, for example, with our flagship fund to have 3 billion of private capital only, right, in financial inclusion. So the ambition is really that at some point, since, you know, as we build the track record there, we could build a track record in something like private equity, something like climate adaptation. But of course, it takes time. And so I guess it's important, again, to keep in mind these two angles that shouldn't be necessarily in conflict, but brought up in parallel.
Perfect. Thank you, Alessandra. So I think what we're hearing is that there are some climate investment models that are just more ready and more able to be standardized and scaled. And there are others that are more in the innovation end of the spectrum, and they are more bespoke and still innovating. So with that in mind, and with that sort of juxtaposition, Jesse, where does the role of DFIs, where is that important in all of this? Is it still important at both sides, or is it more important on one end or the other? And to add to that, where does blended finance fit in all of this? Because we've heard that mentioned a few times.
Sure, great question. So I won't presume to say exactly where we add value, or that we're definitely adding value, although I hope we are. I'm really keen to hear the panelists' answer to that. But I do have a few thoughts on what we at least try to do. I think one of the things we bring to the table is our ability to originate assets in the markets that we operate in. So we've been in Africa and emerging Asia for 75 years, and we've been structuring transactions in these markets, for all that time. So we don't expect every asset manager to have that same on-the-ground presence or to be as familiar with all of the 70-plus countries that we invest in. We can play that role. We can find deals that make sense, and when we know that they meet the certain risk-return profile that someone like ILX is looking for, or one of BlueOrchard's investors is looking for, we can share that deal, and we're very happy to, especially in the changing context of development finance and the real need to scale up capital. We're also happy to, as part of that, to take investors along on the journey that we've been through in understanding how to get really good performance in those markets. So Manfred, pointed out the history of the GEMS data and the sort of history of outperformance of DFI assets in these markets, very strong recovery rates, relatively manageable default rates. I know there's probably more that we can do to share that data more broadly, but I think that is something that we can do to help get investors comfortable with the real risks and opportunities in these markets. The second thing that we bring is patient capital of various forms. So we can provide debt, equity guarantees. We can fit into structures that others are putting together, and we can kind of be that missing piece that helps a structure address the constraints of an institutional investor. So Anand mentioned the need for fixed cash flows if you're investing insurance money, and that means there needs to be a sort of junior layer of capital that can absorb some of that volatility. Sometimes you also need a formal credit rating. Again, that requires a level of first loss capital. We can provide that. Now, sometimes people think that's only concessional capital, but I think one of the things I've been very interested in this past year is we've seen a lot of managers make really a tremendous amount of progress in bringing and designing structures where that junior capital is catalytic but not concessional. So it actually earns a very decent return. And that means that we can really use our entire balance sheet, not just our limited pool of concessional funding. But again, we can bring that capital that can go in first and come out last and really absorb lots of different risks if it helps get commercial investors to the table. And then the third thing that we can do is really amplify what works and encourage the industry to scale that up and replicate it. And so I think the mobilization competition that we ran this year with Mercer was a really great example of that. We asked the asset management industry to send us their best blended finance concepts, design structures that they thought would mobilize at scale for the climate agenda. And we got a set of amazing responses. BlueOrchard was one of the excellent winners that came out of that competition. And our role there is to really look at those proposals, figure out which ones we think we have faith in, and then encourage others to bring those to market and replicate those and do that at scale. And so I think that's a role that we can play even beyond our capital, which usually we mainly like to use to support the first transaction of its kind. Once that transaction is done, our role is to sort of get out of the way and encourage others to follow and do more.
Perfect, thanks, Jesse. So I think building on that, Alessandra, I don't know if you want to take just a couple of minutes. I am mindful a little bit of time because we want to leave some time for Q&A, but to just really unpack a little bit more about the blended finance proposition that we mentioned, that Jesse mentioned. You won the mobilization competition, or one of the winners for the mobilization competition, and why is that important in this conversation?
Yeah, no, absolutely happy to do so. And since Anand said that after you meet MA needs, you can meet any investor needs, I feel like already kind of excited, right? So that's the target segment. So maybe I'll start from scratch, right? So in terms of blended finance strategies, so we do have 9 active strategies at BlueOrchard, representing 1 billion over the 5 billion of total AUM, and we have been partnering with BII on some of them for some time. And the latest one that we have developed together with BII, it's really a co-creation exercise, I would say. Because what we did this time, I mean, while in the past we really started the concept together with the DFI, the MDB, and then after it was half-baked, we were trying to find the private sector segment that would be willing to invest there. This time we did differently. This time we said, okay, this would be the segment that we want to bring in this specific case is UK life insurers, right? And this is the impact goal, climate action. And so how we can make sure that we bring them in, thanks to the contribution of BII, as just said, not only from a concessional perspective, but really because of the catalytic role, right? Because they will come in with this hat effectively in the strategy. And so we started, really listing down the requirements of this segment of investors to try to match with their matching adjustment requirements, which I can confirm are pretty demanding. And so we decided to do so with the asset class where we do have the track record, as I said before, right? If we look historically at what we have been working on, we did for 25 years private credit to financial institutions in emerging and frontier markets. So that helped us in forming the strategy, right? That helped us in creating an instrument as part of this product that will be rated and will get to investment grade. So that is suitable for an investor like Phoenix, other UK life insurers, and then effectively also for insurers outside the UK. But again, we started very ambitious, wanted to meet these matching adjustment bucket requirements, and we did so. So I guess that's the difference compared to what we have done in the past, right? To be able to really mobilize private capital at scale. we did this co-creation exercise, right? So we started really collecting the requirements, not only of the DFI with whom we are partnering, but also of the private sector segment that we thought we should have brought in. And so I guess that's the way we should also try to replicate this forward, right? Because again, if it works with such a demanding type of investor, I guess if you start early on involving your investors, doing some sort of segmentation in terms of their requirements, you could really replicate for other products.
Great, thank you, Alessandra. So I think this is almost a sort of full circle back to what we heard at the beginning, the initial session around sort of value system, really thinking about an ecosystem. How do we work together as stakeholders rather than just a couple of stakeholder types coming together, baking something and then presenting it and hoping to bring people on board, to be much more genuine about that collaboration across the different types of stakeholders, particularly the capital that we want to scale up, because obviously we can't scale without bringing them to the table and really delivering to their needs. So I want to ask you, Manfred, a question about ecosystem, because I know that you've thought about this quite a lot, about the ecosystem perspective and the way we should look at the markets. What are the things that you think we should be looking out for, any pitfalls that we should be avoiding, and the different roles for different ecosystem players?
Yeah, I'm trying to answer it in a way that is most, because I was taken a bit by the comments in the first panel, which is, it's really about finding transactions, because you can talk about the broader objectives and everybody can get very emotional about it or less emotional, but it's very much emotive. And I think the transactions ultimately is what makes the private sector move. Yes, there are philanthropists who also do philanthropic things, but at the end of the day, they've also made their money in the pure private sector. So I think from my side, I see the opportunity about creating a market that has been hidden a bit because of its public ownership, but that's very much now ready and available in the new world we live in for those large pools of private asset owners who have an aligned interest in terms of they want to do good, they're looking at next generation, they can invest for the long run, they can invest patiently, and they're already doing so. They are the biggest investors in private credit and private equity globally. So we need to work with them, embrace them, and have them come to the table to do transactions in the end. And I think there are 5 factors I see as critical. I see them as dimensions across return, risk, and impact. The first is just pipeline and scale. It's a mystery. Everybody talks about it, but we need to demystify it. What's the pipeline of BII? What's the pipeline of the IFC and the EBRD? Just be open about it. Talk about it. There is a lot has improved, and they're far more transparent than many private credit managers. But if we want to find the breakthrough, then we need to unlock that scale and that pipeline, because it is there. Secondly, it needs diversification, and that's not easy because they're not all in the same marketplace. So we need to create the ecosystem that recognizes that diversification. BII is part of the European Development Finance Institutions Network. The MDBs do a lot of talking together. But finding and being open about the diversification of the opportunity is critical, because without diversification, this is never going to work. Thirdly is the issue around data. Big progress been made. The GEMS data has been mentioned, but there's so much work going into impact and sustainability reporting and sourcing that we can't hide from that. And already now we are seeing a lot of traction whereby the climate finance objectives of the MDBs is being adopted by the pension funds invested in ILX as their measure of climate finance. It's a massive breakthrough. If we see the European pension funds begin to align their climate finance with MDB definitions of climate finance, we have a winner of scale that is beyond imagination. And so having us talk about the sustainable reporting requirements, the IASSB, whether or not it's global or European or British, doesn't matter, but talk to each other and make sure we capture the data elements as much as possible, again, across the 3 dimensions of return, risk, and impact. Fourthly is the standardization. The reason why the derivative market works and Nasdaq works or the London stock is the standardization of instrument. So please let's work on that. We're going to sign 2 projects hopefully with BII. The issue that we're working on hardest is to get the document standardized in the way we do our documentation. It's not about the impact of the country or the sector or the return or the risk or the impact. No, it's about the legal document. So standardization of documents is something that we can't hide. And the last point is just cost and speed. This is not a Wall Street big fat carried interest market. This is a market that needs to be cheap and fast and scale. Then it will work. If we're trying to make this a niche market that can sit alongside all the other nice private equity, private credit strategies that have treated many investors and many GPs well over the past decades, this is different. This needs to be a very cheap and fast market, and then we'll catch the scale.
Perfect. Thank you, Manfred. I'm very mindful of time because I want to leave a bit of time for Q&A. So we do have just 2 more questions across the panel, and then please do have a think of some questions to ask. Joe, I just wanted to know really what Mercer's thinking is around this. How can we create and scale the right models? Because we've heard about different challenges and opportunities. What is it that Mercer's seeing across the views that you mentioned earlier?
So I think to a large extent, look, I don't want to kind of repeat everything that I'd said previously. We can't, we have a very diverse client base. I think it's hard to sort of speak to everyone. And I think all I would sort of say is that we were really excited to do this project because there's a point at which the private sector does need leadership from organisations like yours who, hearing about sort of the work that Jesse and team do, we need your expertise as much as sort of, you might need ours in sort of our side of the fence. And I think, some of the things that we learned when we did the project with you is that, having that leadership and having somebody with experience who can, investors to coalesce around, like the importance of that can't be understated. But my word, the private sector came out to play as well, right? You had kind of 60-odd expressions of interest. I suspect that if you ran it again next year or the year after, that would kind of at least double as sort of the word starts to get out. I think, the amount of innovation, again, like Jesse mentioned, the different approaches that kind of came through within that competition, like it's really quite exciting. Now, clearly it still feels sort of quite new. So I think we've got a real job there to go out and sort of use the momentum that you could develop from this sort of type of project and basically test it out so that, lessons that we could learn in terms of the sorts of things that other types of investors are looking for can be built into the next project and the one after that. So I think it might feel like early days, but it certainly feels like there's some good tangible stuff out there that sort of, I think you will sort of achieve much more mobilisation. You'll get more the next time round because every project gets better and better kind of, but no, I think sort of there's some real good stuff to learn from.
Great, thank you. And I think that comes back to the point around sort of bespoke nature in the initial days and then standardised as we start to scale. Anand, final question over to you before Q&A. How would you like to see the ecosystem working better together? Is there anything specific that you'd like to see? I know that you're on different fora for conversations. Are there anything specific that you're encouraged by?
I like that you changed the question from the plan that you had for me, but I'll take that. I think quite a few things here, right? So I think one of the questions I did not address previously, it's linked to what you just asked me. Most insurers in the UK, and let's talk UK for now. US and Europe, that'll be another hour if you want to discuss. Most insurers, most insurance balance sheets, whether it is DB capital or DC capital, they would have sustainable transition and or productive ambitions. And productive, for the lack of a better word, has been framed from a UK perspective. So it has to add to the UK economy, the UK GDP, UK job creation, and so on and so forth. Put that aside for a moment. Mansion House Accord has a clear tagline and a clear connection with at least 10% of UK DC assets going into private markets, and specifically with a view to go and plug UK productivity gaps. What we are asking for on the back of the task force, so you asked me in terms of wish lists, from a task force perspective here and on the other side of the pond, is can we even chip 0.5% or even 25 basis points of that DC allocation towards investing outside the UK. Because what they say is at least 10% in private markets, in all things productive, of which at least half has to be in the UK. So presumably 49% of that 10%, let's assume floor, can be invested globally, right? So in terms of wish list, my point number one would be that, is there an opportunity? And this goes back to Manfred's point and Joe's point, and Alessandra as well, in terms of where can you actually land, capital deployment. It's very important to not just talk about project, construction and development, but about where is the capital actually getting deployed, because that is where the proof lies, right? And selfishly from an insurance asset origination perspective, the way I would think about it is, from a DB perspective, most insurers in the UK, they have their own in-house asset management. I sit in one myself. So what are we trying to do here? We are trying to see, besides guaranteed projects, which are far and few, and MDB capital as such is quite constrained, how do you make that capital go further? How do you get the best bang for the buck? And for us, I think what we have observed in all things IMF, World Bank annual meetings and BI convened events and others, is that is where blended finance and fund finance, particularly the example that Alessandra and Manfred have given, albeit with different types of origination. This is private EM origination, that is MDB being alongside MDB, right? There are benefits to both those kind of constructions, because that is fund finance, which can be sold in the form of LP participations, i.e. equity participations from a DC standpoint, but also from a DB standpoint, to the extent they are trying to raise private debt, can actually pay us quite well in terms of risk-adjusted returns, but also benefits from DFI catalytic capital. So you have actually enabled private EM origination, one order of abstraction apart, if you will, right? You have brought in MDB capital that goes that much further. So if they had $100 to deploy, instead of doing $100 guarantee on a single project, imagine splitting that $100 and being oversimplistic, but please do bear with. You chunked it into 5 parts of 20, 20, 20 each. And you got 80 on each of those 20s to go into private debt constructions. Imagine how much more mobilization you just ended up doing. And it is not that you are not benefiting from the MDB origination. Heck yeah, MDB actually at the first place, the DFIs have done extensive diligence on any asset managers that they have put the first loss capital into, which means private debt investors, private capital investors can benefit from that diligence. Plus, you're working with specialist asset managers who have an established track record. And there are other managers in the room as well, not just trying to single out ILX and BlueOrchard. There are quite a few asset managers here. The fact that, Joe, to your point, there is this competition again, and there is more interest coming from the private asset management community, ecosystem, which helps MDB capital go that much further, is something that can be utilized in both DB capital as well as DC capital. Let us not think that it is only meeting one end of the stick. Absolutely not. We are very closely looking at this space for the sheer reason that, one, we are able to benefit from the DFI diligence on the private asset management capabilities. Yes, sure, it is not MDB EM origination as such, so you can't apply GEMS directly to it, truth be told, but it is MDB enabled private EM origination. Make no mistake about that. And they have a strong sense of control, the mission control on how that private EM manager performs over time, including sustainability and impact reporting. So there are many benefits, and how you sell this proposition, not only about getting into MDB EM origination, i.e. origination done by the MDBs, which is what the ILX model is. You are partnering as a long-standing partner with MDBs, but also private EM origination that has been enabled, catalyzed, which GEMS doesn't speak to, but it's still catalyzed and enabled by the MDBs. So I think I would say in terms of wish list, it's about scaling these things and really selling that story well to customers, depending on what they want. Let the customer be the end choice maker.
Wonderful. Thank you so much.
So lots and lots of content there. I am very aware that we have overrun. I know, Joe, you need to head off, so please feel free to do that before Q&A.
It's fun.
Okay, you can do Q&A. Wonderful. I do want to hand over to the audience if you have any questions. If there was any stone that was left unturned, because I know that we did talk about a lot. Yes, please. Would you like to take the mic, or there's a roaming mic?
So, Aaron Koshka, I head impact investing at Invesco. We manage money to about 2.1 trillion for assets for clients around the world. And also just drawing on my former hat as head of asset allocation at Standard Chartered Bank. So my question is, basically, we know that strategic asset allocation is key. On the institutional side, potentially it drives 80 to 90% of portfolio returns. So the question is really, to which extent are your experiences of having engaged probably a little bit further up the upstream in terms of the value chain, in terms of engaging with asset allocators, as opposed to the deal teams the fund teams that are then making fund selection decisions. What your experience has been in that regard, and just where they're going with allocating assets towards impact investing. Thanks.
Perfect. Who'd like to go first?
I'm happy to. Yeah, well, we've got experience with obviously Europe's largest pension fund, who was the leading investor at the beginning. They've gone through over the past few years a journey themselves. So we started off being alongside the EMD, but there's a new pension system in the Netherlands, which is kind of a hybrid DC, and there is a attraction to making a core allocation to private debt that has low risk and high returns. That's what they're all hunting for. But that could become a bigger part of the overall pension system. But literally, as we speak, they're going through quite a complicated, and all the pension funds in the Netherlands are going through, of how to integrate private credit performance measurement against risk indices, because that is still very undeveloped. Private credit goes from default to AAA. What risk metric do you put against the Dutch AAA mortgages and restructured debt that's in default? So finding the right place for private credit is something that I sense is a journey that I'm sure for Mercer spent a lot of time in it, is the industry is trying to figure out. There's a lot of desire to allocate to private credit, private debt versus public bonds, but how to, from an ALM standpoint, what duration do you put on it, what credit risk do you put on it, is a journey where the indices are not yet equipped to do it. I mean, private credit indices are not transparent. They're owned by GPs. MSCI just launched a integrated private equity, public equity. And so this is a journey that we're literally, as we speak, from an impact standpoint, what we're seeing, and this is what is where we currently reside within Europe's largest pension fund, and what they've made a 30 billion carve-out for impact investment. That's quite unique, and that's distinct, and it is purely focused on private markets, because they want to be able to know the use of proceeds. There needs to be a theory of change. They want to be able to report on all the outcomes, but that's quite a unique and very specific mandate. Others we're seeing more along the axis of risk return index that you can apply to all the assets. So yeah, I think your question is very pertinent, because I think all the larger pension funds are literally going through this process at the moment.
Great, thank you. I think we have a question over here. Yep.
Hello, this is Ayşe. I'm a professor at Roehampton University on sustainable development, and I was also in Belém as a delegate party for Gambia government Ministry of Environment. I do several projects in sub-Saharan Africa on clean energy transitions and just transitions. So they wanted to delegate me in these negotiations. So one aspect that one of the main part of the discussions were the sustainability of any type of just energy transitions, clean energy transitions, investment projects, any adaptation, let's say any adaptation, mitigation and resilience projects. What is your idea on involvement of academic or science, and what type of strategies that you adopt to have more involvement of science in your decisions? And do you think is it important to have science in order to have more sustainable impact
We're smiling
on
because
your investments?
we kind of had this discussion a little bit earlier, in the sense that Manfred was saying to me, but Mercer, you should go away and you should do a research note, possibly with academia, to really kind of sell the asset class. And I think there's probably something in there, but we probably won't do it because I don't think that the science will necessarily drive our clients to make decisions. It's not that it's not important, and I think that our clients will want empirical evidence, they will want a broader sort of set of opinions, and they will want proof points, like of course they will as they go through the journey, but I don't think that that is necessarily what will be at the top of the kind of decision tree in terms of sort of driving them. I think we have to think more broadly than that, and I know, for example, you know, if you're sitting in academia and you know that that's the answer and you know that the evidence is pointed in that direction, then it's super frustrating that that's not kind of driving decisions. And I'm really genuinely not saying that it's not important. I think it's part of that whole sort of holistic decision-making process. And the more evidence there is, like, the better. But I think sort of also one of the things, I'm hoping I'm not going to go off on a tangent for you here, Hazel, but we are... This is very anecdotal, and it's also a me view rather than necessarily a Mercer view, but we are getting a lot of pressure from a broad swathe of our clients to be much more short-term than we've ever been before. Long-term, you know, I could write a paper on the death of the long-term investor, and that worries me for all sorts of reasons. It may be I could give you a much broader answer to your question along these lines as well. And I think that that means that we are going to have to grab people with things that kind of really matter to them today, next week, next year, rather than necessarily thinking too long term about sort of the kind of evidence base. Maybe it goes back to the point on the previous panel about transactions rather than sort of maybe a longer term plan. I'm not sure. But I feel that if we are selling an idea to a client at the moment, we need to be super sharp and in the moment and benefits over kind of the reasonably short term. So it might not sort of be the answer that necessarily you wanted, because I think it's really important, but I think it's additive to the whole.
The question is to what extent those short-term projects have long-lasting impact?
Yeah, no, 100%. 100%, but it's a stepwise thing, I think. And sorry, that is not labelling every institutional investor. It's more just a kind of anecdotal issue that we seem to be facing at the moment.
I just had a very short recommendation to make. If there is a way of connecting UK SDR labels, you know, the sustainability improver label, focus label, and so on and so forth, with the need to actually get short-term, medium-term, long-term scientific impacts really well understood. Because at the moment it's a bit loose. It's not as granularly defined as it could possibly be. I'm just making a suggestion. If you had to go down the line of how do you get regulatory developments and scientific developments to come together and the need for doing so, that would be one way to go.
Yeah.
Right, thank you. But I think what we're hearing is that it needs to be talking in investor language, and it's not
No,
necessarily that proving that climate change is happening or that it's going to be happening quicker if this or that happens. It's not the point of why the investment decisions are made. So I think that's slightly...
There is a point around proactivity, though, I think, as well. I do have it, again, in my head, that there is probably an appetite for some investors. So one of the debates we have a lot at Mercer is, like, where are we on net zero? So we have lots of clients who have made commitments, and they are all on sort of a particular path, and their portfolios look very pretty when they look at the numbers, and you sit there sort of saying, well, that's great for your portfolio, but how does that actually translate to what's going on in the world? And I think there is an appetite for doing things that are more proactive, forward-looking, return-orientated, investment-related sort of first, which again I think is why we're so excited about this project, because it's something that our clients can get hold of. And if you can get hold of something and it feels more real and you're not going to maybe see results in 5, 10, 20 years' time, maybe again there's something in that in terms of these sorts of projects.
Tangibility.
Yeah.
I'm very aware of time, and I know that we're very warm, those of us that are in the room. So I'm not sure if we could. I know there was probably some questions coming through on the chat, but I think we probably do have to wrap it up there. We can continue for those of you who are here in person. We can continue over drinks if you do have any more burning questions for us. But I think for now, I think we just say thank you very much to our esteemed panel. Thank you very much to all of you. Just handing over to Amal for some final remarks.
Thank you. So just to make a few closing remarks, I think this has been, for me, a great event. This panel was almost like a microcosm of the discussions I was part of and listened to in Sao Paulo. I think, Manfred brought up the focus on billions to trillions, and, it was Addis Ababa in 2015 that this billions to trillions for infrastructure came up, but then in the context of Paris Agreement and the SDGs, we're also talking about billions to trillions. But I think really then, in 2016, we were not really having joined up conversations. I think I was in an MDB actually in 2016, and we were talking, I think, past each other. I think in the MDB community, we were talking quite a lot about financial engineering. And I think the institutional investors were saying, well, where's the pipeline? I think, Manfred's point, this visibility of pipeline was what we were being asked for in that context. And frankly, we didn't really understand how important that was at that time. But we've clearly come a long way. I think, looking back, Paris, COP21, and also Glasgow, COP26, I think really provided very catalytic impact to the financial sector. I know the whole focus on net zero has become rather challenged in recent times, but as going back to what I heard in Sao Paulo from the asset owner community, they're not doing net zero for net zero's sake. They're doing it because of their fiduciary responsibilities, and they're not backing down. And I think, as we've heard, particularly from Jesse, the role of development finance is critical. We need to be more catalytic. I think we are now being increasingly catalytic, but we need to do more, and we need to do that at scale. And that is sometimes about blended finance, but it's also often, in fact, very often about patient capital, particularly equity. I was really pleased that in the last year we've heard a lot more about the focus on equity and the role that can have in being very catalytic, which is something very dear to British International, to our heart. So I think for me, and I hope you agree here in the room, but also online, we should take away some reasons to be optimistic in terms of the fact we're not talking about the why or the what. We're very much talking about the how, and how we are delivering and how we can do more. And I think importantly, we've moved beyond the recognition on the value of partnerships to actually showcasing and sharing examples and lessons of what is working and how we can scale and replicate these to mobilize more private capital. And then I think, Manfred, I'm glad you mentioned GEMS, because that also, I think, has in fact, we discussed this in Sao Paulo. There are a number of other non-financial barriers, access to data, the use of data, and we're hearing from investors, they want that not just on the risk, but also on the rewards. So the GEMS, progress with GEMS is a key development. We should all look to its how that can have a future impact. And also, importantly, the role of standardization. And I think clearly we're getting a clearer understanding of that, because again, it's one of those points that I think many institutional investors have said that, but it's not necessarily landed in the way it needs to land. But I think it's starting to now. So lots on the horizon. That we've heard about the role of potential country platforms and how they can be much more help facilitate that more catalytic ecosystem, how they can translate or help deliver on, I think, Rianne's, the GFI's value chain that we saw, how that can help ensure that we increase the number of transactions. We really start to bring out those the pipeline of transactions in a way that really then ensures we are transitioning. And I know a number of events in the new year will be really important milestones. I'm looking forward to hopefully participating in the Mumbai Climate Action Week. And I know London Climate Action Week for most of us here in this room will be a really, really important point next year where we can take stock of the progress we're making and, very importantly, look at how we can scale up and do much more moving forward. So thank you very much for joining us here in the room and also online, and wish everyone that celebrates a very happy festive holiday. Thank you.